Hey everyone, welcome back to the channel. If you're new here, my name is Alejandro and today we are diving into the best ETFs for beginners in 2025. These are simple, powerful picks that can help you build long-term wealth even if you're just starting out. Whether you've got $100 or a few thousands ready to invest, this video is going to show you where to begin, what to buy, and why it works. Now before we get into the actual ETFs, let's talk real quick about why ETFs are a smart starting point for beginners. First, they give you instant diversification. One ETF can hold hundreds, sometimes even thousands of different companies. That reduces your risk a ton compared to just buying individual stocks. Most ETFs have very low fees, which means more of your money stays invested and grow over time. Third, they are very easy to buy. You don't need a financial advisor or Wall Street background. If you have an app like Robinhood, Fidelity, or Webull, you're good to go. And finally, ETFs are passive, which means you don't have to constantly watch the markets or stress out about timing things perfectly. They grow quietly in the background while you focus on your life. Alright, let's start with what I call the core four. These are 4 ETFs that I believe every beginner should at least consider because together they give you exposure to the US economy, technology, dividends, and international stocks. The first ETF is VOO, which tracks the S&P 500. That means you are investing in America's 500 largest and successful companies. We are talking Apple, Microsoft, Google, Amazon, all the big names. VOO is one of the most popular ETFs in the world because it's simple, diversified, and has a super low expense ratio around 0.03%. Over the long term, the S&P 500 has returned about 10 to 11% annually. So if you're looking for a reliable foundation to build wealth over the years, VOO is one of the best places to start. Next is QQM, which tracks the Nasdaq 100. It includes the top 100 non-financial companies on the Nasdaq, which means it's packed with companies like Apple, Nvidia, Meta, Amazon, and Tesla. QQM is basically the same as the original QQQ, but with a lower fee, which makes it a better pick for long-term holders. If you're someone who believes in the future of tech and innovation, QQM gives you exposure to all of the giants driving that growth. Third, we've got SCHD, which is Schwab US Dividend Equity ETF. This one is a bit different because it focuses on companies with strong dividend track records. That means you not only get growth, but also regular income. In 2025, SCHD is paying out a dividend yield about 3.5 to 4%, which is fantastic if you're looking for passive income. It holds quality companies like Pepsi, Coca-Cola, Home Depot, and Texas Instruments, the kind of businesses that tend to stay strong even in rough markets. It's a great pick if you want something a bit more defensive and income focused. And the fourth core ETF is VIXes, which gives you exposure to international stocks outside the US. Think Europe, Asia, Latin America, companies all over the world. It's an easy way to diversify globally without having to handpick foreign stocks. In 2025, we are seeing global competition and emerging market growth, so VIXes helps balance out a US only portfolio. If you only invest in American companies, you're missing out on a huge part of global economy. Now if you got those 4 in your portfolio, you're off to an amazing start, but depending on your goals, you might want to add 1 or 2 more specialized ETFs. So let me give you a few bonus picks that can fit your strategy. One is VNQ, the Vanguard Real Estate ETF. This one gives you exposure to real estate through REITs, which stands for Real Estate Investment Trust, which own things like apartment complexes, office buildings, and malls. They are required to pay out most of the income as dividends, which makes VNQ great for cash flow. In 2025, the dividend yield on VNQ is sitting around 4%. If you want real estate exposure but don't want to deal with tenants or toilets, VNQ is your friend. Another good one is VHT, Vanguard's healthcare ETF. Healthcare is one of those industries that tends to grow no matter what the economy is doing. People always need medicine, hospitals, and insurance. VHT includes biotech, pharma, medical device companies, and more. As the population ages, healthcare demand is going to rise, and this ETF positions you to benefit from that. Then there's VGT, Vanguard's information technology ETF. This one is like a super short tech ETF. It's riskier than QQM, but if you're young and bullish on tech, this one gives you concentrated exposure to companies leading the digital revolution. And if you're someone who wants to reduce risk or you are investing closer to retirement, BND, the Vanguard Total Bond Market ETF, can add some stability to your portfolio. Bonds don't grow as fast, but they are way less volatile. BND is like the chill, steady friend in your group of high energy stocks. It's a great way to smooth out the ride, especially if you get nervous during the market dips. Alright, so now that we've gone through the picks, how do you actually build a beginner friendly ETF with these? Let me show you 2 portfolios, one aggressive and one balanced. Let's say you're 18 to 30 years old and you want growth above all. You could go with something like 50% VOO, 30% QQQM, 10% VIXes, and 10% SCHD. That gives you strong US exposure, growth from tech, global diversification, and some dividends. If you're someone who prefers more stability or you're closer to 30 or 40, a more balanced version could look like this: 35% VOO, 25% SCHD, 20% VIXes, 10% BND, and 10% VNQ. That portfolio gives you growth, income, global diversification, real estate, and bond stability all in one. Before we wrap up, I want to quickly highlight 3 common mistakes beginners make when investing in ETFs. First is over diversifying. You don't need 12 ETFs to be diversified. Most beginners can stick to 3 or 5 and be totally fine. Second, chasing past performance. Just because an ETF did amazing last year doesn't mean it will keep going. Look at the fundamentals, not just the charts. And third, ignoring fees. Even 1% fee can cost you tens of thousands of dollars over time. That's why all the ETFs I mentioned today are low cost and built for the long haul. So to wrap it all up, ETFs are one of the best ways to start investing in 2025. They are simple, diversified, and low cost. You don't need to be a stock picking genius to grow your money. Just be consistent consistent, stay invested, and let time do the heavy lifting. With that being said, thanks for watching. If you found this helpful, make sure to hit the like button and subscribe for more videos just like this. Drop a comment below and let me know which ETFs are you buying this year. And remember, the best time to start was yesterday, the second best time is today. I'll catch you in the next one.